So it's another hold from the RBA. Hi everyone, welcome to the Traders Circle weekly market update. Today is Tuesday, the 1st of August. And just before I get into it, you do need to be aware that anything I say is general advice only. So you need to consider whether it's appropriate for you. So today we had the RBA leave rates unchanged, 4.1%, and it was a pretty 50-50 decision. There were some in the market saying they were going to lift another 25 basis points. There were plenty in the market saying they weren't going to lift, and ultimately they did not lift. So it was more the economists and the commentators saying that they may lift, and it was actually the market that priced in no change at the meeting. And maybe the market knew something that the economists didn't. Maybe they had an inside scoop. Not accusing anyone, not saying anything. We know Philip Lowe, looking beautiful here, has had meetings with dinner meetings with investment bankers before, but I'm not alleging that was the case at all here. So no change at this meeting. They did leave the door open for more rate rises in future, as you would expect they would, though they did say that the recent data has been consistent with inflation coming into target range in their expected time horizon. And previously that's been between now and 2025. So it is pretty interesting because we recently had the CPI data that came in slightly lower than expected, but still at 6%, still more than double the target range. I think perhaps they also looked at the recent retail sales data, which was quite terrible, really, really bad retail sales. And the recent inflation data, and they did point to it in the RBA statement, a lot of the inflation has come from essential services, things like insurance, housing increases or rental increases, rental equivalent increases, and stuff that potentially wouldn't be too impacted if rates were to rise again. They sort of alluded to the fact that housing costs did increase with a lift in rates previously, and so perhaps by holding they thought it wasn't going to be too inflationary moving forward. So no change at this meeting, but definitely still live for the next few meetings. The market in the next sort of 3 months is definitely pricing in another rate rise. The 90-day bank bill swap rates are 3 months out, they're still 25 basis points higher than the cash rate. And so the market is still pricing in at least one more rate rise and possibly 2 more rate rises this tightening cycle. All going to be data dependent though. It's all going to come down to how the data looks. And hopefully we're starting to see a bit of a drop in those inflationary expectations. Hopefully we're starting to see some businesses start to feel like they can't get away with any more price increases, and hopefully we start to see that cap a lid on things. In terms of inflationary pressures that we do want to watch out for, we want to keep an eye on oil. Part of the reason why inflation did come down so much in the second quarter in the Western world was a big drop in oil prices over that period, and in the past month or so we've seen oil prices start to push back up. So definitely keep an eye on oil. Keep an eye on energy prices, keep an eye on transport costs, because if there is another rebound to this inflation cycle, it's probably going to come from the oil space. All right, another thing to discuss is the US earnings season. It's roughly half the way through at the moment. We've seen a lot of big companies report pretty good earnings. We've seen a lot of companies report better than expected, but not continue to rally. And that's not that uncommon in a US earnings season. You do often see a lot of beats and then the share price falls. Part of that is due to the forward outlook they give, but part of it is also due to the fact that historically the vast majority of reporting companies do exceed their earnings expectations. And so we can see that on the chart here. Historically, around 75% of companies in the US do beat earnings expectations. It's a bit of a collusion effort between the analysts and the companies. They set a low bar, and then on average about 75% of them beat that low bar. So if we have a look at the gold line there right at the end, that's the current earnings season, like I said, about half the way through, and it is pretty much average. It's the average beat rate for the last sort of 4 years or so. So it's been a pretty good earnings season, but it's not been a great earnings season. And as this earnings season has progressed, yes, US shares have held their highs, and they've held their highs for the past week or so, past 2 weeks even, but they haven't been able to progress any further. The earnings season hasn't been great enough to get the shares to progress further in price. Interestingly, I read some commentary this morning that even where there were beats, a fewer proportion of beat stocks rallied after the beat announcement. So either, investors are wisening up, or investors are perhaps starting to become a little bit less confident, or perhaps it could be the fact that US shares have rallied 20% in 3 months, and that to keep them going higher, things need to be great but not good. So that takes us to our own earnings season. The Australian earnings season is about to kick off. It kicks off in earnest next week. We had an outlier, an early report from Rio last week. That was probably a bit worse than expected. I think they missed on both earnings and dividends, and the share price fell here, fell in the UK, fell in the US. It wasn't enough to drag the other iron ore miners lower, and in fact they've held up pretty well over the last few sessions, holding near their recent highs. So the earnings season, the majority of reports will start to come in from next week. I think we've got CBA next Wednesday. That's the first of the major reports, and definitely we could see some earnings surprises this season. I think this season you're going to see some large movements. You're going to see some pretty outlandish reports. And in fact, we've already had some early disclosures from a lot of companies who don't want to fall foul of their ongoing reporting requirements. And we've seen some pretty severe movements on the back of those, both up and down. So when you are considering a trade or investment at the current time, make sure you definitely check the investor calendar before doing so. Jack, our colleagues, put up a lovely one on our website. Go to the calendar, click the report, see when the date is, and consider how that may influence your trade or investment. Typically, this is a pretty bullish time for the Australian market. We tend to rally in late July, early August, and then we start to sell off towards the end of August and into September as stocks go ex-dividend. There will be plenty of dividends this season, so if you are an investor, definitely you want to be hanging out for those dividends as well. So let's have a look at the technicals now, guys. If we have a look at the US market, this is the S&P 500, and they've been on a mammoth uptrend for the past 3 months. That's that hot pink line there. The hot pink line is about a 20% uptrend from the lows of March, and then they've had this accelerated uptrend, and that's the desaturated pink line here, and that's been going for a bit over a month now as well. So they've rallied up to a bit of resistance here at 4,600, and they've really been unable to eclipse that level for the past fortnight. So it's been 2 weeks of just grinding sideways to slightly higher into that 4,600 level. And this is what I'm saying. If the share prices were going to rally just a little bit further, we needed to see a great US earnings season, and it was good, but perhaps not great. Not enough so far to get them through that 4,600 level. It's only half the way through. There's still plenty of big companies to report. You've got some large pharmaceuticals reporting tonight. Merck and Pfizer, I believe, amongst others, and there's still plenty of big enough reports to shift the needle, to shift this market higher, but it definitely does look like that steam is starting to run out. 4,600 would be the level to eclipse. If they break that, it's a bit of blue sky, levels we've not seen for 2 years now. If they fall, they'd have to break through this roughly 45.20 level, break through the accelerated uptrend, and then we'd expect to move back towards the previous support resistance level at 44.50, which is where the longer term underlying uptrend currently sits. Looking at our own market, the XJO, and we can see that it's jumped strongly higher today with the RBA, but really we weren't able to get above the levels of Thursday last week. So we may be finding some resistance at 74.70. This was a bit of a level maybe intraday back in February, and for me this is the level we'd have to reach to go back to our yearly highs. So if we can get through that level, 74.70, I'd expect to move to about 75.70, which was the yearly high, and if that breaks, we're going back to the all-time high. Doesn't look like we have enough momentum right at the current moment to breach this level though, so if we do come off a bit from here, I'm looking at the 73.70 level as a potential support level. If we go below 73.70, we're looking at a move towards around 72.80, the previous support resistance level. At the moment, the technicals aren't super directional. Yes, we've had a big move up, but that momentum is no longer as positive as it was. We may be starting to stall out a bit. Prices are starting to get a bit expensive, and if you are considering buying, you may now decide to wait for the company's earnings report. So that's it for this week, guys. Hopefully you enjoyed. If you did, click subscribe. If you didn't, click it anyway, and I'll see you in the next one. Bye for now.